Hey everybody, this is Bill from the Bill Heenan Real Estate Team, and welcome back to the Bill Heenan Team YouTube channel. It's been a little while since I've done a local market, Southeastern Connecticut local real estate market update, and I wanted to jump on here and talk a little bit about what we're experiencing. I didn't have much to report in December. I think the last time we were on here was the end of November, and December was a typical December month where it was hit or miss. Not a lot of units are being sold. We did have a lot of activity though, I must say. Like we typically generate between 300 and 350 leads a month, and in the month of December, we hit one of the highest lead generation months of my company's history in generating leads, and we went through about 450 leads over that month, which is an incredible amount of leads, and it was a very, very good sign. But I wanted to talk, but we weren't sure exactly what those signs were starting to mean, but I think we're starting to get a little handle on this at this point. So I want to talk a little bit about where we were and where we are now as well. I looked at the numbers, the appreciation numbers since March of 2020 when COVID first hit, and it's incredible. In most places we've seen between a 30, even upwards of a 40% appreciation in pricing. So, so those of you that own homes, I own a handful myself, we're sitting in pretty good shape at this point, whether it's our primary home or any of our investment assets. We've seen incredible growth here in New London and Middlesex counties, and hip hip hooray. I mean, we needed it. It had been a long time since we'd seen any significant appreciation, and here we are now. Like before the winter started, or in late fall, we were kind of keeping an eye on the absorption rates, and I think the absorption rates, meaning how many homes are selling on a daily basis versus how many homes are on the market. The absorption rates were holding somewhere in the 20s back in October and November, and here we are at the end of January 27th, 2023, and the absorption rates seem to be holding their own. I wanted to go indulge a little bit further into those absorption rates, more so than I typically do. And like I said, it's January 27th. I'm standing here. I don't know if you can see what the focus is like, but I'm in a short sleeve shirt today. It's warm. It's the temperatures have spiked into the 50s this weekend, and any projection of long-term temperatures look like we're going to have a pretty mild rest of the winter so far. So knock on wood. And what that has done is it's really motivated the market. And in any typical scenario, in any typical year, I would tell a seller that our spring market starts after the Super Bowl, minus there being a bunch of snowstorms hammering us. And this year, it seems, because our temperatures are so warm, as also a result of the interest rates dipping a little bit, our spring market has started to take off in its full capacity. So our showings are through the roof this weekend. But let's take a little bit of look at the numbers. I'm going to use my laptop here, so don't mind if I look away. But as I look at the absorption rates for New London County, over the last 60 days, we've sold over 800 homes, 809 homes in New London County, and we have 304 active homes for sale as we speak, and we're selling about 13.4 homes a day, which means we have an absorption rate of about 26 days of inventory. So it would take, if we didn't list any more homes at this point, it would take 26 days for us to move through the inventory that exists in our local New London County market right now. And then if we start to look at Middlesex County, the numbers are very similar as far as the absorption rate's concerned. In Middlesex County, we have sold 483 homes over the last 60 days, and we have 198 homes for sale, giving us an absorption rate of 8 homes being sold every day. And we have about 26 days worth of inventory. So those are very, very strong seller-oriented numbers, seller-favored numbers in any given market. So, when we're sitting anywhere below 60 to 45 days or 45 days or less, it's a strong seller's market. I would still be willing to say that it's one of the strongest seller's market that I've seen in my career. And, once we start getting towards that 45 and 60 days worth of absorption, then we start to move towards more of a balanced market, but we're a long way away from that at this point. And New London County, Middlesex County, the state of Connecticut in general has been shown to be in the right side of this shifting market over the last year. Like, we have a lot of jobs, and jobs is always what determines how strong our real estate market. We have too many people moving into our area and not enough housing in order to support those moves. And as a result, people are buying, selling their existing homes, they're buying up to the next level homes. So we're just in really, really good shape. And I think that even if we do see any level of shift here, that we're not going to see, it's going to be more of a, no further appreciation shift rather than a heavy depreciation shift. And I'm not saying that we don't lose a couple of percent over the next 18 months or so, but it certainly looks like we are on the right side of this shift. And compare that to what happened to us in 2007 and 2008 during that shift, during that recession, during that crash. I like to call it a crash because there's a lot more than just a recession. We were on the wrong side of that scenario. We had thousands and thousands of jobs just pull out of here in a matter of months within the year. And it took a long time for us to double back, get those jobs back, and get this thing moving a lot longer than any other part of the country as compared to even where I grew up in Philadelphia, where they rebounded after 3 years. It took us a whole decade to rebound from that 2007, 2008 crash. So, but here we are. And then I wanted to look at something else too. I wanted to look to see at what the cost of the rates are at this point. I hear a lot throughout the days and week, certainly a lot of feedback from my agents and our buying clients. What about the interest rates? Should I wait for the interest rates to dip? Now, I'm of the mind that we'll never probably be back to that 4% interest rate. I think that was always a government supplemented rate, and I think that we've learned a little bit of our lesson around that. But I do believe that the knowledge the government has around controlling that prime rate and how it can control our economy, I think they've gotten a lot smarter and a lot more intelligence around that. So I do think that they will control it to some degree without supplementing it heavy. So right now we're sitting at about a 6% interest rate if you have good credit scores above 740. Which is a great rate. Any of us that are over the age of 40 would tell you 6% is a tremendous rate. But when you're comparing it against a 4% rate to all those millennial buyers out there right now, it's kind of a hard pill to swallow. But if you take a look at what that really represents, like if the rate moves from 6% today and up through 7% in the coming months and throughout the rest of the year, and they still plan on bumping that prime rate up a couple of quarter points, 2 more times I'm hearing at this point. But if it was to move to 7%, you would have cost yourself on a typical $300,000 mortgage about $200 a month, just under $200,000 a month for its 30-year schedule. And over that 30 years, if you were to keep, now there's a lot more to the formula than this, but if you were to just to calculate what you spent, what you wouldn't have spent if you were to capitalize on these 6% rates, you would have spent $71,000 more over that 30-year schedule, which is an incredible amount. And when you look at the numbers, cost of your financing $500,000, the difference on a $500,000 mortgage between 6% and 7% is $328 a month, or $118,000 in mortgage interest money. So, or in mortgage money, not even mortgage interest money. It was just $118,000 more over that 360-month payment schedule. So I think that the more mindful buyer would recognize the fact that you should get in while we've got these dipping rates right now. And it's our belief that you should get in no matter what the time is, because the tax savings on your primary residence is significant, especially when you compare it against throwing money into a renter scenario where you're getting nothing back, through the Home Mortgage Interest Deduction Act in your personal income taxes. So it's always a great time. But if we look at it this way, certainly with the dip in these rates, you should get out there right now. So the other thing I wanted to talk a little bit about too was, some people say to me, well, I'm waiting for the prices to come down. So, that's legitimate. I mean, we could very well see a little bit of a depreciation here. I don't think we're going to see anything significant at this point, not in New London and Middlesex County. But let's say that the rates did dip a little bit. But I wanted to look at the forecast a little bit. If you look at, any of the people that know much better than I do nationally, it looks like that some industry experts are saying that we might get a further appreciation out of this year. I don't think that's going to be the case. I think that we're going to just hold our own. But some experts are saying we might get as much as 5% appreciation this year, where other experts are saying that we might reduce as much as 5% this year. So let's look at the market, that same mortgage schedule, if the prices adjusted by 5% down in a depreciation scenario. So if I look at that and I say, all right, well, let's take a look at that $300,000 mortgage. You would have saved, if the mortgage level went from $300,000 to $285,000, and you purchased that $300,000 mortgage at 6%, and then you waited for the prices to go down and only mortgaged $285,000, it's still costing you more money, about $97 a month. Like the heavy is always on the interest rate, not on the price, up to a certain point. So, and then over the 360-month schedule, 30-year schedule, you would have cost yourself a simple $35,000 in mortgage payment. And that scenario continues throughout the schedule. If you were to wait for the prices to adjust, rather than getting a $400,000 mortgage and the prices came down a little bit and you only had to get a $380,000 mortgage, there still is significant savings if you were to capitalize on the 6% interest rate versus the potential 7% interest rate in a raising interest climate. Because remember, the things that are the one big controller of what makes the prices go down is the interest rate pricing going up. Otherwise, the price just doesn't fall. Not in our local counties, at least. We have too many people and not enough housing. The pricing of our homes are not just going to fall, minus some large layoff or some closure of one of our economic engines, which I'm not hearing any of that at this point. Otherwise, the only thing that's going to drive that interest rate down or that pricing down are the interest rates. So if your pricing went down by 5%, in this case $20,000, and you had to finance $20,000 less, then that means what got it there was a rising of the interest rates at 7%. And even at that scenario, $380,000 at 7% cost you an extra $129 a month. Over the schedule of the mortgage, it would be almost $47,000. And the numbers continue in that fashion. If you were rather than paying or mortgaging $500,000 if you at 6%, if you mortgaged $475,000 at 7%, you would have cost you $162 a month, and a total mortgage schedule, over 360 payments, almost $59,000. So, so on and on, the story kind of continues that if you're a buyer and you're thinking about buying at this point and you're waiting for prices to come down, that you really need to stay more focused on the interest rates and the rates rising. Now, that being said, you can always refinance, right? Like, that's what we tell most buyers at this point. It costs about $3,000 to refinance. So if the rates do go from that 6.5% or 7% or the 6% rate that they're at now, and they drop back down into the 4s, well, $3,000 gets you a refinance. So, hedge your bets. Get into this marketplace as we speak. Take advantage of the home interest mortgage deduction in your pocket. Take advantage of the principal pay down that you will experience on a monthly basis. Take advantage of the long-term appreciation over your years of ownership. Take advantage of the fact that this is your asset. You get to improve it. Improvements means it's worth money. Start building your legacy now and jump into the market. Get out there, capitalize, and buy your first home or buy your second home, upgrade your home. And if you're a seller, there's still time. The market is still one of the strongest sellers market that I've ever experienced. So once again, if you're looking for any more information, you can always reach out to us through our website, thebillheenanteam.net, or you can always reach me directly on my cell phone at 860-460-8053. I always look forward to hearing from you, and have a great day.